Thanks everybody for being here today for our Friday conversation. We are grateful to have David Frazier from the Frazier Group, Managing Director over there. How you doing, David?
I'm doing great. I'm so excited. Thank you.
Yeah, thanks for being here. Got a lot to talk about. I think the Frazier Group is well known in Utah, particularly having grown from a family office and kind of transitioned into a more traditional fund over recent years. But before we kind of get into all that, just tell us about yourself. What keeps you busy? What keeps you ticking?
I went to BYU, then joined Bridge Investment Group, which is a real estate fund. John here saw me as an intern, so it's been fun doing that. Then I left Bridge, joined my dad, and started investing in young Utah software companies for the last 12 years. So
Awesome.
We're a family office, so my dad, a brother, a brother-in-law, a sister, all work out of the same office, which is usually very, very fun.
I was going to say usually.
Usually very, very fun.
Yeah. Any family jokes we need to get out right now?
No, that's I don't know I'm brave enough for that. But
Later.
Scott does have favorites. He does have favorites, so.
Good. And are you him?
Nope. He said, we asked, who's your favorite, Dad? And he said, well, it's whoever needs me the most. So he's got 8 kids, and so.
Here you are. Cool. Well, we're glad to have some family here as well. This is great. Let's talk about Frazier Group, kind of 30,000-foot view looking down for a little bit. You guys are doing sourcing deals Mountain West all the way out, Washington, Montana, Wyoming, California, obviously a lot here in Utah. Let's talk about Utah for a minute. What do you feel like is so special about Utah?
Well, we've been here for the entire scope, just about. Scott started investing in, I think, 1997, co-founded the first angel group in Utah, the Utah Angels. He said there was a lot of demand built up for venture capital for angels. In their first meeting of the Utah Angels, they had Ancestry.com pitch, and I believe the predecessor to Omniture, and another company did really great called True Vision, and later True Hearing. So their first meeting, they had 3 billion-dollar companies come out. So.
Right. Yeah. Those are big names. Very.
But yeah, it's been really fun. Utah is growing much quicker than anywhere else. I wouldn't want to be a VC anywhere else. There's more companies in California, but there's way more competition, and so we're really fortunate to be in Utah.
What do you see as the difference maker in Utah? Why is there more opportunity? Maybe I'm speaking from Silicon Slope's perspective, a little biased here, but what makes Utah different compared to other markets?
Utah is demographically, it's young, and it's got a lot of good values, a lot of people that are really driven. It's funny to see companies kind of spin off great talent. Mm-hmm. You see when Omniture sold for the next couple of years to Adobe, everyone that's starting a company says, yeah, I was at Omniture at Adobe.
Right.
And later Qualtrics, for a couple years there, every single company you saw, they said, yeah, and here's our VP, he's from Qualtrics, and now Divi. So there's definitely an effect of great companies developing great talent and then kind of diffusing itself through the venture community.
It was I had a close uncle of mine that came over from Omniture to Adobe, and was one of their VPs for a while. It feels like it wasn't even that long ago that Adobe set up shop, and they were just this massive building right here in Lehi, and there wasn't a whole lot else. And then there's just this huge building. Obviously, tons of growth since, and you guys have been a huge part of that growth. Over the years, there's been, I think, 8 IPOs that you guys have been a part of?
Yeah, we've had some highlights. We did GitHub. We're in Filevine, Omniture, Domo, Workfront, Weave, kind of all the billboard companies, Galileo.
Yeah.
So a lot of the well-known ones here in Utah.
That's so cool. And so kind of moving a little bit into the history here, you guys started as a family office, the Fraziers, and let's talk about a little bit about that original, angel group that Scott started in '97. I was listening to, I think the podcast was called Funds That Won, a couple days ago, and in that you were talking with him about, this story of kind of how you created this mantra of shooting fish in a barrel, not throwing darts. Will you just spend a little bit talking about what that means?
Yeah, and it actually started out with some of the family history too, that Scott co-founded the first Utah Angels group. They had, I think, 21 different angels, and they invested for a couple decades. Then they had a reunion after 20-ish years, and they had kept great records of who'd put money in what, at what stage, what valuation, and so they generated a report during that reunion saying, here is how everyone quantitatively did. And of those 21, 3 of them were successful angel investors. And the other 18, many were very successful in other ways. Carl Sun went and started Lucid. Ben Peterson started Bamboo HR. So not that they were unsuccessful people, but
Still very
people who had
right.
an enviable angel investor track record was 3 out of 21.
Wow.
And so kind of playing into that, if you were to ask Fraziers, hey, what is broken with venture capital? It is that the pre-seed stage is just a terrible place to invest in. You put money in, and frankly, generally speaking, angel investing generates worse returns than Series A funds or B funds or C funds or D funds. They're just flat out the worst.
Right.
What I think people fail to do is build relationships when the companies are young and then aggressively follow on. So that's kind of the Frazier mantra, is we will put money into a very young company. In Filevine, for instance, we put in $500K in our initial check, and now we have $16 million invested of cost basis, and it's taken us 7 years to do that. And so we didn't put money in and say, hey, that's our check. Let's see if it's a winner or if it's not. We wrote one check, and then all along the way you're saying, hey, I'm loving this. How can I get more in? Can I get some secondaries? Can I participate in all these future rounds? So we call it shooting fish in a barrel, where your first check is risky, it's tough, but your later checks, you've been on the board for 2 years, 3 years, 4 years. You know the space much better. You know who has shares to sell. So we call that shooting fish in a barrel.
Okay.
And other funds, they reserve some money for follow-on, but they're like, hey, this is fund 1. Let's reserve 40% for follow-on, and that's it. We're putting money into these companies 6 years later, 8 years later, and we're putting in 20 times what we initially put in.
Right. I think, and we were chatting before, you're putting something like 80% of your cash into these best companies, right?
Yep.
And then doing secondaries from there. That's really cool. That success, well, the success, non-success of the 18 or so, I mean, there's a lot of lessons that can be learned, I think, and we'll get into that here in a little bit. Obviously, many of them still very successful with companies we know well here in Utah. But for, opening it up here to, many people in this room, what advice do you have for founders in how they manage the relationship with funds?
For us, the relationship is critical because we're saying, hey, we want to put 20 times our money eventually into the winners, but the winners are the ones that don't want your money because they're the ones that have a lot of options and bigger funds that say, hey, I want to take the whole round. So for us, the relationship is critical. For us, when the Series C comes along and someone's writing a $30 million check, they need to say, hey, I'm going to make room for the Fraziers, not because they're a meaningful part of my $40 million round, but because I like them and because they've been helpful to me. They helped find, hires. I went down to Lake Powell with them. I, can trust them. So building those relationships are really critical for the Fraziers.
So you're saying there are Lake Powell trips that...
Well, there are.
that happen only for...
We call them business trips, and my wife rolls her eyes every time. She's like, is that really for business? And we're like, yes, it is. But, you know, but it's having a relationship is critical to the Fraziers. Without it, the model just doesn't work. Plain doesn't work. You can put money in the A, and then they'll say, yeah, you're too small.
Yeah.
For individuals, for founders who are saying, what should my relationship with a VC be? I actually feel like it's kind of flipped, where I feel like you should take a VC's money and then do whatever you want afterward. I feel like a lot of founders, they say, hey, I'm going a full court press to impress this VC, to get their money, get a lead, I'll tell them everything. And then they feel like they've committed themselves to a trajectory. They're like, hey, I've got to hire 15 salespeople this year, and I've got to do this level of growth to meet their expectations, to kind of meet a commitment I made to them. And I feel like that is the exact wrong way. I feel like you should tell them whatever you need to get their money. As soon as you got their money, you should flip it around and say, what is the very best thing I can do for my business, period? And does that mean I'm going to take 2 years to reach the growth that they're hoping? Maybe. Like, certainly grow fast, and that's why you're taking VC money, but don't feel committed to like a relationship in that sense. Like, just say,
a
at the end of the day,
transactional
they're going to
relationship.
I'm going to build them the best company I can in the way I think, and just treat them with respect, but don't feel like you are their employee per se. I feel like that's the most healthy relationship.
That's cool. Yeah, I was about to ask, how are you guys doing this differently / doing it better? But I think you just answered that. That's really cool. And back to the Lake Powell trips, I think that might have to hear more about those. That's definitely a good way to build relationships, heaven on earth, for those who haven't been. I think it would be interesting to kind of hear about, total assets under management and what it looks like here in Utah. Just take a minute or two to talk about what those numbers look like.
How much money Scott has?
Well, I guess...
Or funds, the funds.
Yeah.
We're deploying about $30 million a year into Utah, mostly software, surrounding state VC companies.
Cool.
So $30 million a year, most of that going into follow-on, but a lot of it going into young companies, like smaller checks, but a bunch of younger companies. We're doing pre-seed, we're doing seed, we're doing the whole gamut. So
yeah. I think this is actually a perfect transition into AI. I think you said when we were chatting earlier, you guys are looking at about half of the deals you're looking to source are in AI, right?
Yep. AI is something we think will make a lot of money for a lot of people and will lose a lot of money for a lot of people. I like to think a lot of the companies we see, I think they're just doing market research for larger language model companies or larger companies. We saw a company that does uses AI to generate sales analytics for a sales team, and they were seeing some good early success. But I'm thinking to myself, hey, is Salesforce, their number one goal right now is asking themselves, how can we generate analytics, using AI in our own platform? And so I feel like there are many AI companies that are kind of an addendum. They're not the model. They don't own the customer. They don't own the workflow, and there's no value there. We're investing in we're in 4 AI companies now. The most recent one is an attempt to make AI more usable, called Enhanced AI. So back in kind of the spring of 2023, the number of users of ChatGPT shot up to an all-time high, and now it's down, I think, to half or so. And probably a lot of people in this room too can say, hey, I got really excited, I signed up for ChatGPT, and now how am I using it? Like, have I used it the way I thought I would? No. It's because it's not terribly usable. It's kind of you ask for one thing, it gives you back something kind of good, and takes a lot of iteration. So this company, Enhanced AI, It's kind of like Lucid Chart with AI in the middle of it. So Lucid has these boxes, and you draw arrows between them and create kind of a flow. And this does that with AI. You say, hey, I want to generate marketing material. So it'll drag information, data out of a couple sources, and then ask the AI a question. Say, hey, find the names of all these people and give me some more information about them. Go research them, research their company, put it in this marketing material for me, and then refine that and take away all the phrases that sound like they're AI, make it sound better, draw another arrow, take another box. So, and it's all no code, no developer. Mm-hmm. So anyway, maybe that's too much in the weeds, but that's the kind of AI stuff that I like, is like, hey, you're not going to beat the large language models. You're not going to make a stronger AI. If they own your customers, then eventually they're just going to eat your lunch. But a very niche application of AI where you own the customer, those are really exciting. Or like this most recent one, how can I make AI more usable? How can I kind of, anyway.
Yeah. What sort of risk process internally are you guys going through as you evaluate these AI companies? Because there's still so much up in the air when it comes to scaling a company whose core is AI. What does that process look like?
I'm convinced that AI is extremely, extremely powerful. A lot of the companies that are pitching, saying, hey, we're going to put AI in this thing and get this thing done, it works, and it works really well. We were in one called Pathology Watch. It looks at skin samples for cancer, and it works really well. It cuts the time that a pathologist needs to whatever 20 divided by 8 is. Not that good at math. Need Excel. Whatever that is, it's cutting down their time more than like 60-ish% that they need to find the cancer. So I'm convinced that it's really powerful, and if you write off AI as, oh, it's all bluster, that's a mistake. It's super powerful, but I'm terrified that the large organizations have an advantage over small ones, and so that's where all my thought goes in on these AI companies, is like, who's bigger than them? Can Salesforce come in tomorrow and eat your lunch?
Mm-hmm. Speaking of Salesforce, were you able to listen to Jaron Paul? We had him in a couple weeks ago. Super exciting.
We were obligated to come. We were investors in Spiff, so
good.
No, it was great. And he at the end, what did he say? Something like every person needs to be involved in AI. If you're not, you're crazy.
Right. Yeah.
Jaron's super smart.
He's super sharp. Yeah. Let's talk about with the focus you guys have in Utah. Back to kind of offering some advice back into the community, because you mentioned that pre-seed money that's kind of a hot topic right now. Where is pre-seed money going, and why for a lot of people, are they not ever seeing that again?
I think a big element of pre-seed money came from angels, came from harvested founders. It's, hey, so-and-so just sold their company, they got $30 million, and they see a bunch of young ideas that remind them of the company they built, and they're like, hey, I'm going to write the first couple checks. And that's always been a very big element of pre-seed. And it's dried up the last couple of years because companies haven't really been selling, haven't been going public for the last 2 years.
Why do you think that is?
A lot of the valuations were way too high in 2021, and interest rates went up, and everyone had to say, look, money isn't free anymore. Mm-hmm. Valuations aren't what they used to be. So all the companies, we're in several companies that are just like, hey, we're ready to go public, but we're not going to because we don't have to, because they're not going to pay us very well.
Right.
So for whatever reason there is, a bunch of reasons, companies aren't going public, not as much money acquiring companies for financial reasons. Like Spiff got acquired, but it was because they were a strategic acquisition for Salesforce. So they're like, hey, we could dump this into all our other customers and make a bunch of money. Mm-hmm. But so for whatever reason, companies haven't been selling, so a lot of the pre-seed money is just gone. And if you're looking at pre-seed in a vacuum and just saying, hey, is this single check worth writing? All the Series A funds, all the B funds, they look at that and say, the data is pretty clear, that's bad money. And they don't do it, or they feel like they have to do it just to kind of play the game. But we get around that by attempting to leverage those companies much more than others. We're saying, hey, yeah, this first check, I wouldn't call it a loss leader because we only invest in companies we love, but like, hey, this is our first check, but we're not going to make the bulk of our money on the first check. We're going to make the bulk of our money by being someone that they will take our money for 6, 7, 8 more years.
Yeah. Speaking of companies that you guys love, would love to kind of just hear the journey, in the process beginning to end of Filevine. We were talking about that earlier. Talk through what that looked like.
We first, so Album had invested before us. They were raising a Series A round. They were out pitching a bunch of funds, but they were out of cash. And they're like, hey, we don't want to appear desperate. We want, a couple $100,000 on the balance sheet so that they can't take advantage of us and can't force us to do something. So we gave them that money just on pretty favorable terms, real fast, real easy, to just kind of let them run their A process in peace. And then we put money in the B and the C and the D. We've bought stock, anytime an employee leaves, we call them up and say, hey, what are you doing with your options? They're going to expire in 90 days. So we've been very aggressive from $500K initial check to 16 million. But behind the scenes, getting that 16 million, I would just say it's hard. Like they wouldn't normally have given us all that. We had to do several things along the way, which I guess I'll brag about because we're here to brag. But in the A round, we had negotiated in the pre-A round, the bridge that we'd put in, we negotiated a valuation cap, and then the A round came in higher than that cap. They said, hey, they've offered more, and they're using your money as a negotiation tactic to lower the valuation because they're saying, look, you took money from the Fraziers lower just 3 months ago. And so we agreed to raise the valuation if they'd let us put more money in. And so we were kind of accommodating, and they're like, hey, we want you to raise the valuation. Normally people would say, that's stupid, why would I? And that's not my problem, but we're trying to figure out a way to give them what they want and get what we want. Kizik, we led 2 rounds in Kizik. One of the executives had a daughter with some physical challenges, and we asked Kizik if they would, and they would. This is before they made kid shoes. They bought a Nike shoe, cut off the back of the Nike shoe, and installed the hands-free element and painted it red, which was this girl's favorite color, and gave her a kid shoe before you could get a kid shoe. And that was really cool for this executive. And we took him to Lake Powell, which we did. So it's like stuff like that, where it's just like, hey, can you work with them when they need stuff for you for business? Can you do nice things for them? Do they trust you? Do they like you? And I think those kind of things go really, really far. Yeah.
Those are the stories we need to hear more. I think that sort of relationship is very unique. Ed, that's a cool story. Thank you for sharing. Let's before we kind of start to open it up to questions here in a little bit, let's talk about advice for founders in general. In an area in Utah where it's extremely competitive, it's very fast-moving, high growth. Just in general, what advice do you have for founders as they're scaling?
We very recently invested in a company called Parallel, pre-seed. So anyway, we did a recent pre-seed investment in Parallel, and I think everyone should copy what their founder does, Renato Villanueva. He used to be at Divvy. He is extremely, extremely driven. I would say he's every bit as smart as anyone else, but he is taking twice as many customer calls. He's pitching twice as many people. He's talking to investors, twice as often. He's just go, 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 go. And I feel like he has twice the opportunities to refine his pitch, twice the opportunities to refine his product, twice the opportunities to find the right customers. So if I were giving advice to founders, I would say that was hugely impressive to me, how driven, how fast, how agile, how quick he is to just get feedback all the time, talk all the time, go, go, go. And I hope he wins because of that. And I think he's much more likely to. And we're more likely to put money in because he's agile, he's fast. He's not saying, hey, this is polished, it's done, I'm going to spend a year and build this beautiful thing. None of that. Just running all the time.
Yeah. Love it. That's super cool. Great advice. Let's open it up to questions. I know there'll be several with you here today.
I've got one. So, thank you. Regarding your follow-on rounds, I have two questions about that, David. So first, how much percentage-wise are you setting aside of each fund to be able to do follow-ons? And then next question is, how much of that same round, or are you doing more from your subsequent rounds to follow on because there's so much, 6 or 8 years later?
This plays a little bit into a way that we're different from other VCs in that we are wholly disconnected from which fund goes in. We just say, hey, here is the current fund. Every opportunity from every company is going to be done out of this fund. And as soon as it's done, we'll start another fund, and every opportunity from every company is all going to go into that next fund. So in terms of like, hey, this fund, it reserves nothing for later, for follow-on. But that fund is benefiting from past opportunities where, we've been investing, we built out a portfolio that's generating opportunities that's pouring into the fund. So we've kind of sidestepped, in a sense, that issue of how much do you reserve, how much, can we really put? And that untethers us and lets us kind of go crazy when we think it's time to go crazy. So we cross-fund all day, every day in an extreme manner, and we just say, look, that's the risk you get, putting money with the Fraziers. Because also as a family, we are less beholden to LPs and more beholden to, we just want to make money. So if we think it'll make more money, then we'll
Bigger Lake Powell trips.
We'll cross-fund. We'll cross-fund.
What are you seeing in the macro environment as the economy seems to be warming back up? Are you seeing more people, coming with pitches? It seemed like there was a solid dry spell back in 2023.
Yes. In the first half of 2023, I don't think we invested in a single new company. And in the second half, we invested in 7. We had 5 companies sell in the last 4 or 5 months. So I'd say yes, it's absolutely warming up. Kind of why it went so dry, I attribute mostly to interest rates. It's like, hey, you just can't value a company at 12 times revenue when interest rates are high, when the cost of money is higher. So I think a lot of the optimism is kind of around, hey, will inflation be low? Will interest rates drop? And the more you see that coming true, I think the more you're going to see companies saying, oh, let's go buy some companies. Let's, go public. Let's go back to hopefully normal. So I think that's what in my mind drives it all, is kind of interest rates. But there's great businesses in every stage, like every time. And like Spiff probably didn't sell at a time when there was a financial advantage to selling. Like if they'd have held on for 2 more years, a financial buyer would have said, hey, I'm willing to offer a higher multiple for you. But when the time is right, the time is right. And Salesforce was an incredible acquirer. So I would just say, just run your business anyway and don't worry about macro too much. Unless you're going to sell and you're selling to a financial buyer, then I'd probably say think about waiting.
Alex over here on the other side. You mentioned that a lot of AI startups right now don't own their customer, don't own their workflow. What are other things that you're looking for in new AI companies, like other benefits or reasons, like such as those two examples you gave?
Yeah, and as you were mentioning to me before this, a lot of companies are just a wrapper for ChatGPT. They just say, hey, we put a .ai at the end of our domain name, and we ask these questions to ChatGPT, and it gives us these answers. So there's tons and tons of that. And I think what distinguishes good AI investments from bad, I think one great way to win is to pick a niche that isn't going to be dominated by somebody else. And you say, look, you know, this space is too small for a giant player, but with a lot of focus on this exact customer, you can win. We invested in a company called Opinion. They started out doing exactly what Podium does, which is like reputation and reviews and surveys and stuff. And about half of their business was selling to like sports clips and other just random companies, and the other half was all in multifamily real estate in apartment complexes. And when we invested, like the first thing we told them is like, hey, you should get rid of, I mean, don't get rid of them, take their money, but you shouldn't sell a single new regular customer that competes with Podium. You need to sell entirely to multifamily, and you need your product to work exactly specifically for what a property manager wants and nothing else. And the surveys need to happen when multifamily needs them to happen, and the reviews need to be this and that. So they did great afterward, and they shifted entirely to multifamily. And that's how I feel about AI. Like maybe some of your customers are not in your niche, and I would just say like keep their money, but don't sell a single new one. Just figure out where you're going to win, and then kind of double down on that.
About 20 years ago, the state of Utah created this fund of funds, you know, to try to incentivize VCs to come invest here and disrupt that chicken egg problem of lack of startup, you know, lack of VC money and lack of startups to fund them. You know, today there's VC money all over the place. I'm just wondering what, based on your perspective, did the fund of funds kind of have something to do with that? Was it a catalyst, or was there something else that got us to where we are today?
Oh, you guys are not going to like this answer, but one day we got a check in the mail from the state of Utah. Scott got a check, and it was for a couple $100,000, and it was for like they'd set aside a bucket of money in the state to support early stage investing. And I think they just kind of ran out of stuff to do with it, so they just mailed money out to people that had made a bunch of angel investments.
How do we get on that list?
And it was yeah, I know. It was totally unsolicited. We didn't know it was coming, and we're just like, oh, a couple $100,000. All right, your tax dollars at work. So, I don't know. I'm of mixed feeling about kind of state-led efforts. That's how I feel. I feel like there's great companies and great founders, and there's great VCs. So I don't see the state of Utah having a critical role anymore.
I know sometimes like startups have a hard time getting money from venture banks, and I've heard about this term private credit. Is that a way for startups to get their money if they can't get it from a VC?
Private cred?
Private credit.
I mean, at the early stage, you do what you got to do, for sure. So I'm not super familiar with who's lending that early, because usually it's viewed as like extremely risky. To me, the first money you're going to get are from friends and founders and angels. So as you're looking to start a business and you're like, hey, this is too early for VC, first ask yourself, can I bootstrap it? Or if you can't, then I think talking to all the wealthy people you know is probably your next best bet, and all your family and friends and family. So I'm not really familiar with who's lending that early. in private credit. And I guess I would add that I'm not a big fan of personal recourse debt for founders, especially early on. So if it were me, I would avoid it probably. I've seen a lot of companies where the founder is all in and they're like, hey, this is my baby and I need this to work no matter what. And then they take personal recourse and then it's not their fault, but the company doesn't succeed and it just wipes them out all the way and it just really sucks. And it takes a long time too. I think one of the founders had to go through like bankruptcy for like 6 or 9 months where they couldn't work, or if they worked, it would just go to like creditors, and like it was just a very sucky time. And so I don't know that I'd recommend that. But also do what you got to do.
I think on the pre-seed part of venture capital, I think everyone would agree that there's some problems that we need to fix. Fraziers are doing great. What are some other what are other VCs that are doing well in that area? And two, how do we fix it generally speaking, because it has so much benefit downstream?
Yeah, that's a great question. One thing I've always admired is Kickstart's collective. So what they do there is they have kind of the traditional VC model is, hey, let's make some one-on-one relationships. And where the challenge is that these pre-seed companies probably just frankly don't fit in the time that a VC is able to give them. Like a VC has a lot to offer, but they don't have that much time to spend on every pre-seed investment. So Kickstart made a collective. They have a bunch of resources. They have events where all the heads of marketing at startups, all the heads of sales have a different event. So they have kind of some events, some resources where it's not pulling from Kickstart's time directly, but it's kind of pulling from Kickstart adjacent people that want to help each other and have a community. So I've always thought that's really cool. I think they do a great job with that.
I don't know if you can see me, so I'll stand up. But a question for those of us who are founders in that seed stage and we're just trying to get our foot in the door. What do you suggest for us to make us stand out and then also to continue the conversation so they don't stop after that initial conversation?
Great question. I think there's kind of a spectrum of investment. The pre-seed is purely idea-based and saying, hey, look at my resume, look at this idea. Wouldn't this make for $1 billion company? And then once you get to the A round, it's kind of, or B round, it's kind of fully shifted over toward metric-driven, where any B round investor is saying, I don't care what your ideas are, because your ideas are already coming out as evidence in your financial records and your metrics, and your churn is low, and therefore I think your product is good. So there's certainly a spectrum, and depending on how far along you are is how you need to approach it, and you need to shift. Once you have metrics, those are more valuable than ever. How to distinguish yourself? I think personal introductions are a great way to go. So if you can find connections that people have, I highly recommend going on LinkedIn and saying, who do I know that is connected to Gavin Christensen at Kickstart, and ask them to write an email introducing you. I think that's more effective. Are there other elements you want to talk about? I don't know if that's a good enough answer. I feel like I've forgotten part of what you were asking.
Well, I'm new to the space, and also, as you can see, I'm female. And working on an AI project as a female, I feel like sometimes it's hard to be taken seriously. And so I'm just trying to talk to as many people as possible. And I've had some great connections and introductions. And I'm really early, right? Like, I'm just barely starting to even introduce myself to people. But I just want to make sure I'm approaching it the right way, so I'm not losing out on any opportunities or, stopping the conversation because I didn't talk about it the right way. That's more my concern.
I'm of the opinion that pitching, the more people you're pitching, the better. and the longer breadth of time at which you're talking to them, the better. Meaning, if you talk to somebody, you give them, the wrong way to do it would be say, hey, I'm giving one pitch to Kickstart and I'm done, and I hope I impress them enough that they do a deal. And more effective, I view, is, hey, I don't even know if I'm raising money, but I want to tell you my idea, and I want to, socialize this with you a bit. And you talk to someone at Kickstart and say, in 3 months, in 6 months, this is where we're headed. This is some customers that are really excited. And then you go back 4 or 6 months later and you say, hey, I'm back because things are going great. And, I told you about these opportunities and they were better than I thought. And so I think kind of a sequential, to the extent that's possible, is really effective, because especially with early stage, they're taking a huge, gamble's the wrong word, but like huge vote of confidence in the founder. And so if they've met you one time, they'll say, oh, she seems pretty smart and she knows what she's talking about. If they've had lunch 2 times and you've socialized ideas and then you pitch them, they're like, oh yeah, I know her, and it's far more persuasive. So I would definitely treat it, to the extent you can, as a longer road. I guess that's all I've got for you.
I think we got time for
one of our most recent investments in a company called Find Mine has a female-led AI startup. She's super smart. They do AI for large e-commerce brands. So
cool.
Anyway, I hopefully you're in good company.
My question's about the family element. I only recently started reading a book about creating family businesses, and I know from Qualtrics, the goal of the Smiths family was to bring the family together, and it turned into Qualtrics. So talk a little bit about what the Fraziers do, and maybe you have an angel mom, but if you've got 7, 8 siblings, that means 30 grandkids. Like, what do you do to create the harmonious open-mindedness?
Thank you for that question, and Scott should probably answer it, because this is his everyday concern. It's mediating between 8 kids. But I think if you are leaving money to kids, that is the bare minimum kind of modest effectiveness kind of thing. Like, hey, when I die, you're going to get some money, and aren't you happy about that? I am happy about that. But far more effective is building careers for each of the kids, saying, hey, Scott kind of got me into venture. I had burned out at Bridge Investment Group, this real estate thing, and he's like, do you want to work with me? And I'm like, sure, I sure do. And he's got several of his kids. One is a programmer that he's helped in his programming career. One does marketing. So Scott has made a very fixed effort in passing along career advancement, passing along opportunity. Hey, I'm going to get you a really great internship because that's going to get you on the path. That's going to make a really big deal to kids and to grandkids. So I guess I would say the money isn't going to drive, I think, a lot of happiness necessarily, compared to, hey, one of my kids has a better career, they're better at what they do, they're more fulfilled in their life. So that's probably the biggest one for me, is think along those lines. And it's hard and it's really long. Like, it's not just, hey, I made this one intro and it's done. Scott puts a lot of thought and a lot of care and a lot of love into it, so something I've learned from, for sure.
Well, first of all, it's very hard. The most difficult part of it is jealousy, because the more you have to pass on, and whether it's internships or referrals to people they can work with, or whether it's money, then the more jealousy you have. So it's doing that with the family is more difficult than building a good business or a good fund. But it's been my focus for the last 10 years. I mean, I try to raise financially literate kids, so every couple of weeks or at least every month, we'll have a meeting with the whole family, and we'll sometimes talk about family things, but we talk about how the business is doing, and so that everybody knows what it's like, whether they're involved day to day or not. I think that's all I have.
Thanks, Scott. That's actually a perfect end to, I think, great questions. Thank you, David, for being here, and thank you for the impact that you, Scott, and family have had in Utah. It's incredible.
Thanks for having us on this. I love these events.
Yeah,
We go to a lot of them, and they're fun.
They're a lot of fun.
Thank you, Colin.
It's all about community. So thanks, everyone, for being here, and we'll see everybody next week.